In April of 2014, the FASB issued a new standard on discontinued operations. Because of the importance of some of the changes, I want to spend a few minutes highlighting some of the more significant implications. The bar is being raised on what qualifies as discontinued operations. Basically, a disposal must be a strategic shift with a major effect on the company's operations and financial results. The new guidance should result in fewer instances of discontinued operations being presented. The determination is still made at the time of disposal or when a disposal group is held for sale. Keep in mind, most disposals are through a sale. However, a disposal can also be by other means, such as abandonment or spin-off. Another change is that under the prior guidance, if there was continuing involvement, a company would have been precluded from presenting discontinued operations. Now, it is not necessarily the case. For example, if you had an ongoing relationship with a disposed unit, like a supply distribution agreement, a company could have been precluded from discontinued operations presentation. Now that's gone away. The company still has to think about what its balance sheet and income statement will look like before and after disposal to figure out whether it has a major effect on its operations and financial results. Only then can it be accounted for as discontinued operations. For example, if the company has a continued relationship with a disposed unit such that the disposal does not result in a significant change in revenues or costs, that may not have a major effect on the financial results and not be eligible for discontinued operations. Let me focus a little more on the key terms strategic shift and major effect. Even though the threshold for strategic shift is not defined in the standard does provide some examples. These include a company disposing of a major line of business or a major geographical area of operations. It could also include an equity method investment. This is a change, as equity method investments previously were not eligible for discontinued operations. The concept of strategic shift is intended to be entity-specific. Companies should evaluate what qualifies for strategic shifts based on the facts and circumstances. For example, a company that only operates in the Northeast region of the U.S. may conclude that each state represents a major geographical area. On the other hand, a large multinational may conclude that each continent represents a major geographical area. Again, it is very judgmental. The standard also offers other examples, such as a product line that constitutes 15% of revenues, or a geographical area of operations that constitutes 20% or more of total assets, or an equity method investment that constitutes 20% of total assets. Those are not bright lines, but they are quantitative indicators. Companies should use them as data points when evaluating the facts and circumstances around discontinued operations. In addition to revenues and assets, companies should be considering other key performance metrics, like cash flows from operations. In terms of evaluation period, we believe the company should emphasize the most recent completed current and next annual reporting periods. Again, keep in mind, if the disposal does not or will not have a major effect on the company's operations and financial results, it would not be treated as a discontinued operation. The FASB introduced incremental disclosures, especially in the area of continuing involvement. Also, with more disposals being included in continuing operations, new disclosures are required for disposals of individually significant components that do not qualify as discontinued operations. The standard was issued near the end of the first quarter with prospective application to all new disposals of components and new classifications as held for sale beginning in 2015 for most entities. Early adoption is permitted. Companies executing or contemplating new disposals should start thinking about the new rules and assessing which disposals are strategic and major. Lastly, in addition to the impact on the financial statements, companies will need to consider the effect on MD&A, especially in explaining how their trends may be distorted as a result of fewer discontinued operations.
you.